Welcome to the BNB Investing Podcast for real estate investors. Fix and flippers and realtors exploring investment options with Airbnbs and short-term rentals through acquisition, leasing, or management to generate consistent monthly revenue. Join us for a chat with experienced and successful short-term rental investors to hear their story of how they got started and created wealth by building scalable businesses. We also explore various service providers and lenders that help make our businesses more efficient and maximize revenue in this awesome sharing economy. Welcome your host, Rich Monroe.
Hey everybody, Rich Monroe here with BNB Investing Group. Thanks so much for jumping on this week. We've got a good friend of mine, Jamie Lane from AirDNA, and we're going to be looking at kind of the historical market and occupancy levels, kind of what the market trends have been. For those of you that don't know, BNB Investing Group, we help short-term rental managers and hosts kind of navigate the different options of doing the short-term rental business, whether you're trying to manage properties for others, buy properties, or actually do master lease strategies. And so we talked about the navigation of those different models. And then we also like to have, different guests on that can kind of help us learn a little bit more about our business and kind of help us all be more efficient. So Jamie, thanks so much for jumping on with us this week. If you give a brief introduction, I know you've got some things you want to show us, and then we can kind of save some time towards the end for any questions. Those of you guys jumping on, please throw me a quick yes in the chat just to make sure that everybody can hear us okay. Jamie?
Yeah. Do you want me to introduce myself, or you want to?
Absolutely, yeah. Tell us about yourself. I know you're famous and on all the TV shows and everything, but not everybody knows you. So yeah, please introduce yourself.
Jamie Lane, Chief Economist at AirDNA. Been with the company now for almost 3 years. Was a client of AirDNA starting in 2015. So long-time user of short-term rental data, a long-time investor, host, operator of short-term rental units in both Atlanta and the Northeast United States. I got my start in the hotel industry. So as a hotel analyst doing forecasting in that sector for about 10 years before I came over to AirDNA. And primarily when I first started looking at the data, it was all around how hotels were being impacted by short-term rentals, and then got more and more interested in just the dynamics of how the industry was growing, why it was growing, why people were investing in this asset class, what was the income potential of these homes, apartments, yurts, what have you. And overall, I see it, and I love the travel sector. I love helping people make the right investments, profitable investments, and using and leveraging data to do that.
Awesome. So how long has it been that you've been with AirDNA now?
Yeah, I started in October of 2020, so about 2.5 years ago.
2.5 years ago. So you got started just before COVID, or just after COVID. Yeah. During.
Yeah,
absolutely.
My job in March of 2020 was forecasting the hotel industry, which all of a sudden became a really difficult job. So we went from updating our forecasts every quarter to updating them every week. It was a pretty dynamic time.
Right. And it looks like you kind of made the changeover right at the right time, as well, as short-term rentals are continuing to grow.
Yeah, it was almost right around October 2020 that we saw the shift of demand and people coming back into the sector, listings starting to come back, and 2021 was just a rocket ship year for both the industry, on industry performance, on the beginning of sort of supply recovery, and then also just for AirDNA's business. We've gone from 40 people when I joined back in October 2020, and now we're up to 160 people.
Yeah, I'm not sure how you guys keep up with it because you guys don't only do this in the United States. This is a global operation, right?
Yeah, we're tracking every short-term rental unit really around the world.
That's awesome. That's awesome. So let's go ahead and jump right into. I know that you had some stats here that you wanted to share with us,
Yeah.
and let's just dig right in.
So maybe start with one of the more viral data points that was sort of running around over the past month. It was a tweet that came out, I guess it was about a month ago now, sort of calling for the collapse of short-term rental revenue, and that it was going to subsequently lead to a collapse of the housing market, with 1 million listings coming up for sale as people sort of exit short-term rentals en masse. That is not something I believe at all. It is, and I can't really speak to the data that was presented in the tweet, but I can tell you it does not align with what we're seeing in the market. It does not align with what we're hearing from investors, from hosts I talk with, and we have at AirDNA tens of thousands of clients that are subscribers to us that we're working with. We see their data. We're talking with investors. So where on average in the tweet, they were showing about a 40% decline in revenue per available listing, we're seeing in those same markets roughly a 3% decline in the first quarter of this year. And that is to note that we are seeing some softness out there. Like, it is not an environment where we are seeing a lot of gains in revenue. But it's important to sort of put that into context of we are generating average revenues for short-term rentals at 30% higher levels today than at the start of the pandemic. We've seen a significant overall uptick in occupancy relative to 2019. And it is not as high as it was in 2021, but it is still 7% higher than we saw in 2019. And overall, we're seeing revenue per available room, revenue per available listing down about 1 or 2% on average in the first quarter, or first half of the year. And that is nowhere near a sort of collapse. And what we're seeing is more normalization in terms of industry trends.
So I think that's an important point to make. I think a lot of us that have been around for, pre-COVID, during COVID, let's call it, we've been doing this ourselves for 8 or 9 years, but a lot of us that have experienced the great time that we had during the COVID months, forget that, a lot of that stuff was inflated as people were moving away from going to hotels to try to keep safe. And then that whole staycation realm of folks being able to work remotely. And so I think we all saw that spike in revenue and average nightly rate that now, to your point, if you compare where we are today to where we were in 2019, we're really not too far off.
Yeah. And to sort of put that into context, Rich, we actually saw a decline in 2020 of supply of roughly 20%. So, and this red line shows where supply was pre-COVID. And then sort of blue line takes over after the onset of COVID, where we saw a really significant decline in listings. Demand came back really strongly, or we had fully recovered back to 2019 levels as of April of 2021. So that's really a rapid recovery in demand, where supply still hadn't come back yet, which meant that, we saw those record occupancy levels that the industry saw, and broadly at the time, we didn't expect them to be sustainable. And we'll look back at that as sort of a high watermark for the industry. And it's not to say that there's any sort of major weakness out there in demand. Demand actually continues to reach record highs month after month after month. We had more people stay in short-term rentals in the month of June than had ever stayed in short-term rentals ever before in the history of the industry. So
really,
demand is there, and that's a figure both in the U.S. and globally. So these are record levels of guests coming and staying in short-term rentals. The issue and why occupancies are broadly coming down, it's just supply growth, listing growth is outpacing the demand growth. So in that June period, we had a year-over-year increase of demand of 14%. That was just outpaced by supply growth that was up 16%. So it is not a issue of weaker demand by any means. It's just Rich, you're just doing such a great job of convincing people to come in and invest in short-term rentals that we're seeing, and the occupancy spread out a bit more compared to over more listings. And broadly, I still see occupancy really healthy. And in the markets that it's declining, either it is significant supply growth or a more normalization of supply or of occupancy trends, of demand trends, of some markets that we're just seeing, like Joshua Tree, super strong demand during the summer when that really isn't a market that you want to visit in the summer. And likewise, markets like Cape Cod or the Hamptons had been seeing strong demand during the winter when it's not a market that I want to go to in February.
So said a little bit differently, as we have demand growing and more people using short-term rentals, we have more people listing their properties to be available, and it's just outpaced it by a couple percentage points to create the sense of, if somebody's already been doing it, the sense that, well, I'm not getting as many bookings. Or from a pricing perspective, a lot of us feel like we have to lower our prices lower than we ever had to before to gain some of those bookings that are out there. I guess said differently too, we just have more competition right now.
Yeah, there's more competition. If you could list your property in 2020 and 2021 and get bookings immediately and not have to have professional photos, not really care about the reviews you're getting or how satisfied guests were with your properties, we've really shifted to, if someone's executing well, they've got a great listing to sort of market their property, they're getting strong reviews from guests, guests are happy, they're dynamically pricing their unit in terms of, if demand's low during a certain period, they're lowering their prices. If demand's high, they're raising it, sort of maximizing revenue throughout the year, not necessarily picking a price and sticking to it, even if the demand's not there at that price point. If people are doing, and even those basic things, we're broadly seeing still pretty strong performance.
Interesting. So yeah, and those are all the things that we teach our group to do. I mean, essentially, we're running this like a business, right? Most hosts that are kind of one-off listings may not be that competitive, but we are doing all of those things around the goal of having that 5-star experience and being able to be differentiated from some of the other options in our market. And that's kind of the way everything that we do is evolved around that. And so that helps you kind of raise to the top a little bit of some of the other folks that may not be doing the same thing.
Yeah, and to put a point on that, the average review score in the US on Airbnb is 4.7. That just blows my mind. And I don't even know if I would stay at a listing with a 4.7 average review score. So there are a lot out there. And that means there's got to be a whole lot of them that are even less than that.
Yeah, for sure. And for those of you that don't know, in order to be a super host, you have to maintain a 4.8 or higher review. And in a lot of cases, there are travelers that will only search for superhost properties for that reason. And so, yes, it is you've got to really be on your P's and Q's to be competitive in this space for sure.
So yeah, this gives a sense of the slide too of the dispersion of supply growth. So while a lot of times I talk about data and talk about the US as a whole, we know that hospitality and specifically travel is a local business, and that what's happening on average across the country is not going to be what's happening in your market, in your neighborhood, in your comp set, or in your property. And there's some markets out there like, and you see Memphis and Sacramento, Oklahoma City, and even in Detroit, and almost 40% growth in listings just over this past year. Atlanta market that we're in, Rich, and some of the weakest supply growth, but still up 8%.
Yeah, and I'm in the Tampa market as well, and it looks like 33% up in Tampa.
And that's a really strong market in terms of supply growth.
What do you attribute this growth to, Jamie?
Yeah, and one is especially in the back half of 2021 and early 2022, we hit peak sort of profitability for new short-term rental investments. And we track this metric over time. So looking at, and I like to think of it as a yield metric. So what is the average revenue that you can earn, and look at that relative to the average home values out there. So if you're making an investment in that market, there's obviously changes in the revenues that you're going to be able to earn as a short-term rental host, and those are up substantially over the past 3 or 4 years. And then there's the cost that it's going to take to acquire that asset, and those costs have gone up substantially over the past 3 or 4 years as well. And then the other piece to that is interest rates, and sort of at the end of 2021 into early 2022, yes, we had seen really strong house appreciation, but we'd also seen really strong short-term rental revenue increases. Interest rates were still low, and that was bringing a lot of people into this industry and maybe looking at it for the first time, which is still contributing to some of these year-over-year changes in supply. Secondarily, we've just seen a new investment continue, even at these higher interest rates. And broadly, the revenues have held. Like average revenue per available listing still only down 2% nationally. So it's not like we're seeing a big reversion in the revenue that you're earning. Home values over the past year are down year over year slightly, according to the Case-Shiller Index and across most home value trackers. So let's say overall home values are roughly flat too. And what that's allowed for is people that are really digging in to the data, they're still able to find profitable investments. It's maybe not a grand slam on every home you're going to look at on that it would be a good short-term rental investment like it may have been in prior years, but there's still a lot of great investments out there, especially in areas where there may be falling home values, and those dynamics around falling home values don't necessarily have anything to do with the popularity of travel to that market, which means there's great values still to be found.
Interesting. So do you have the data? You probably have it, but do you know year over year what this represents as an increase in total number of listings?
Yeah, total number of listings in the U.S. In June was up 16%. So this slide I had pulled out the just top 50 largest MSAs, but we also track all the beach and mountain markets, smaller cities around the country. Some of the beach and mountain markets are where we're seeing some of the slowest growth now. Those are areas where we had seen the most home price appreciation. Now seeing some reversion of those values, but it's still, and broadly, where short-term rental investment is the most unaffordable at this moment, and that's definitely showing up in the supply growth numbers.
So the vacation rental market, lakefront, beachfront, mountain, those properties are going at such a premium that there's not as much growth in those markets as a result of that.
Yep. And then with the return of international travel, the return of people to cities for work, and some work from home ending, more conferences, more sort of just general economic activity in the cores of these major cities is definitely leading to, and a lot of the demand growth that we're seeing in these major MSAs, and making them more attractive again for an investment. And you look at all these markets that are seeing the most investment, and what I see in terms of commonalities is one, either low home values, or areas that home values had not been growing much over the past few years. So calling out areas like Cincinnati, Detroit, even like Memphis or Oklahoma City. So still some price appreciation, but not nearly what we saw on the West Coast or in the Southeast. Relatively lax regulation, and that can be a commonality across many of the southern states and throughout the U.S. And then and Sunbelt demand, and it's areas where people are moving to, that businesses are moving to, and short-term rentals appeal not just for short-term travelers, but also more mid-term rentals. And we're seeing really strong growth among people that are moving. We saw relatively low housing inventory, so short-term rentals can be a temporary housing. There's still a lot of demand around hospitals, universities, that are really popular and growing in the Southeast as people are migrating to these areas.
Got it. So all those kind of naysayers that are saying, it's short-term rentals, it's not really growing anymore. It's, all the rumors we've heard about, everybody's complaining now because hosts are requiring you to clean the property, take out the garbage. I'm paying a cleaning fee. So I want to run back to a hotel. There was also kind of the thought that the major change that Airbnb made on their platform with the way that you search for properties, shifting more over to categories, kind of reset everybody's algorithm as far as where they ranked.
Mm-hmm.
So I think there's all these different explanations, but I think the data doesn't lie. Basically, you've got more people coming into the market that are creating a higher supply. And your demand is still growing. It's still on the uptick, but you've got, like we've talked about before, you've got to be on your game to be able to gather some of those increases, right?
Yeah, and I no doubt the demand is going up. And then the pain and maybe weakness that people are seeing, and you see this across those same 50 cities in terms of, and what's going on with occupancy. We only have 2 markets out of those top 50 that are seeing an increase in occupancy on a year-to-year basis. Those are Washington, D.C. and Boston. So, and you go back and then look at a market like Oklahoma City, Cincinnati, Sacramento, Detroit, they were seeing that 30-40% growth in supply, where demand or occupancy is now falling 10-15%. And demand's up year over year in all that market, but it hasn't been able to keep up with the supply. And so, yeah, you are seeing the overall occupancy declines in these areas. And that's where, and broadly, this was expected. It shouldn't scare people that, I shouldn't invest in in Fort Lauderdale, because occupancy is down 8% over this past year, you just need to get comfortable with, all right, what was Fort Lauderdale earning in terms of occupancy in more normal periods? Like we can, on our app, you can look at the data from 2018, 2019, and all right, here's what occupancy was, here's what it got to during the peak times, and here's what it's at today. So let's get a sense of what this investment would earn as of the numbers today. But then also take a look at, all right, what if I lowered my occupancy 5% more down and getting it back to what it was earning in 2019? Would this still make sense as an investment if let's say ADR stayed the same or even declined slightly? So just getting comfortable with a range of performance and as you're looking at investments.
It just dawned on me that a lot of our viewers are fairly brand new to short-term rentals. Can we just back up a second and give folks a brief explanation of what AirDNA does and how they do it?
Yeah. So we are the world's largest provider of short-term rental data. And we provide that data through a variety of tools on our website. We collect that data through tracking listings on the major OTAs, so Airbnb and Vrbo. And we're sort of modeling the demand of those properties, how much they're earning on a nightly basis on those nights that they're selling, and then translating that into tracking the revenue that every property listed on Airbnb and Vrbo is earning. And because of how we track the data, we're tracking bookings that are made either through Airbnb or Vrbo or booked direct or through any other channels for those properties. So it's a really holistic picture of what these properties are earning. And then like one of our most popular tools is called Rentalizer. And it allows you, and it's a free tool that allows you to search any address in the world and calculate what it would earn as a short-term rental. And we do that by going out and finding comparable properties. So what are properties that are nearby, similar bedroom, bathroom, can accommodate a similar number of people, similar type of amenities, sort of price point in the market. And then and bring those back and average them together to get an estimate of what that property would earn. And then we've got sort of market research tools so you can dig into what are the best areas within a city to invest in, which areas are growing, which areas are declining, which areas are earning the highest occupancies. You can get comfortable with what the seasonality then is of that market. How is forward demand pacing? And then ultimately, once you have that property, how you should price it on a nightly basis. So it's a real, and I would call it a complete data tool to help you go soup to nuts in terms of finding the right place to invest, then understanding what a property could earn and whether you should invest in it. And then once you have that property, how do you maximize the revenue that property can earn?
Absolutely. That was great summary of what you guys do. And so a lot of us that have been in this business for a while, AirDNA is kind of the go-to for looking at your market analysis to determine the profitability of the short-term rental revenue and the nuances and the different changes within each of the neighborhoods within close to where the property is that you're looking at. One of the great tools that I like using is the pacing report. You can kind of drill down to literally week over week, month over month of the booking activity within that market in terms of on a day-by-day basis, not only how many properties are booked already and at what price, but also which ones are still available and at what price they're listed at. So it gives you a good indication of what the temperature of the market is in terms of supply and demand and competitiveness and kind of where you need to be at on price as well.
Yeah, absolutely.
So I'll let you jump back into the presentation here.
No, and that's really all I wanted to talk about in terms of the presentation. If we want to get into any listener questions, happy to and take any questions people have about the data or what we're seeing around the country.
Yeah, sure. So Caroline had one earlier on, and it might have been something that either one of us said, but the question was, what does MSA mean?
Yeah, metropolitan statistical area.
There you
so
go.
It's essentially how the government defines an area or a city. So, and it's much more encompassing of an area than just the city of Atlanta. It covers the entire Atlanta regional area.
Got it. And so that encompasses kind of the supply and demand and what's going on in the metro, not just in the city limits, essentially.
Yeah. So all of these cities that we were looking at is the entire metro area of that market, not just the city limits.
Got it. That makes sense. And so from looking at the data and showing us kind of what's happened year over year, what is your anticipation or thought process with forecasting and predicting kind of where we're going to be next year and kind of going forward? Is this growth going to continue? Are we going to continue to be, struggling with trying to keep up with the demand, or are you seeing any indications either way there?
Yeah, and as we look out on the forward data on how the rest of the year is pacing, and we're still seeing significantly more demand on the books for the rest of the year than we had seen last year. So, and we do expect demand growth to continue. We expect more people to be booking. We expect supply to be growing, but to be growing at a slower pace. So the lack of affordability still in many markets out there for investment has been limiting investment in quite a few markets, which is slowing supply growth. So where this year we've seen about 15% growth, last year we had seen about 25% growth. Over this next year, we expect that to decelerate to sort of 10% to the high single digits. So slowing, which for existing investors and operators, that should be great news. That we're not going to see another year of 15 or 25% supply growth. That's going to get some time for that existing supply to be absorbed into the market, just given the natural growth that we're seeing in demand. More people using short-term rentals, more people coming up with new use cases. The flexibility that we all have to continue to live and work remote is definitely playing into the demand picture. And then I still expect and more international travel to be coming back to the US. When we look at international travelers, we're still about 20% down relative to pre-COVID levels, where outbound demand from the US is 10% above 2019 levels. So we're doing a great job of supporting the European short-term rental industry right now. Europe isn't really doing their part yet to support the US short-term rental industry. And a big piece of that is how strong the dollar is. So it just makes it more expensive for people when they visit the US. Their money doesn't go as far. We are seeing some weakening in the US dollar, which should promote more international travel. And that really is a big deal for a lot of these big cities. And areas like Miami, New York, Boston, Chicago, and they're seeing 30-40% of their demand coming from international guests. And until we get that demand back, and we're still going to be seeing some weakness in those types of cities, in some of the big cities. And even a market like Atlanta was seeing 25% of its demand coming internationally. So if we see that big return, like I am expecting over the next year, and that could be a further incremental demand boost for hosts and continuing to push demand higher. So we're not anticipating any significant declines in short-term rental revenues revenues. We're expecting occupancy to decrease by about another 3% over the next year. Still above 2019 levels, but still working out that sort of normalization of occupancy levels. ADRs we think are roughly going to be flat, maybe up 1% over the next year, which does put revenue down about 1%, 1-2% over the next year. I'm weaker more in some markets, positive in others. But overall, I still see travel as an industry and as a investment and a sector to invest in as something that we're going to see long-term sort of secular trends of more and more people traveling, more and more people spending on experiences. There's not going to be a lot of new hotel investment over the next year or two or three or four. Like those projects have to get started now to deliver in 2 years from now. So we know if more people want to be staying and lodging, they're going to have to be choosing short-term rentals for that. And short-term rentals are continuing to gain share over hotels. And I just see it as a growing sector going forward.
Okay, so you referenced the kind of the urban markets and your expectations in occupancy over the next year. What about the vacation rental market in particular? I know they got hit hard this summer, year over year from last year. What do you see there in the vacation rental space?
Yeah, and it really depends on the market and the price tier. Overall, people are still taking vacations and they're still staying in these markets. It's just a different type of traveler staying at a different price point than maybe they were last year. So, and I'm in Atlanta, and drive-to market for us is sort of the Destin 30A beach market, and people were staying and traveling to that area more and more when they were sort of staying domestic. Now that they can travel overseas again, especially on the higher end, on the luxury end of the spectrum, that's where we're seeing some weakness in that market. Where on the budget side, and we're seeing still continued growth, and that's a trend we're seeing out there. But even across all these vacation rental markets, we're not seeing any declines in demand. It's just a softening in occupancy.
Got it. So we do have a couple questions in the chat that we can hit real quick. So John wants to know, how do you expect the flood insurance recalculation and insurance cost in general to affect the Florida market?
Yeah, and that's a market where in general, it's going to be harder and harder to find profitable investments given the insurance costs. It won't be impossible, but that is where home values are, where interest rates are, and revenues are still there to support that. But if the expenses go up associated with those investments, and that's going to put continued pressure on new investments in those markets. And those are ones where I suspect we'll either see home values sort of correct to adjust for that. And if we're talking about what investors are willing to pay, and if people need to sell the properties, home values may come down to a level that makes sense given the additional expenses. Or we'll just see more people come in that want to use it as second homes and not necessarily valuing it with the same sort of cost structure that a short-term rental investor would.
Got it. So this is an interesting question that Caroline is asking, which is probably on the mind of most investors right now. If you were going to pick a place to invest in some new properties, where would that be?
Yeah, and I'm really following the small and mid-sized cities, and those are where I still see attractive yields to be gained, and we still see the fastest growing demand. So it's something that still a bit surprises me, and given that people are still visiting these destinations, but I think what people found is that they don't all need to go to the same destinations, and you don't need to go to the same national parks. There's lots of great areas to explore around the country, lots of great cities out there, and that we can spread out the demand a bit more. There's lots of areas that haven't seen the home price appreciation that others have, and that's broadly where I'm looking. So markets with maybe less than 100,000 people living in them, home values have gone up less than 20% over the past 3 years, and that we're seeing strong occupancy and ADR and earning potential. So I'm not going to give any names, but that's sort of the profile of markets that I'm looking at these days.
Okay, and you guys do. I mean, you actually put out pretty regularly a quarterly report that has a lot of stats on what's going on in different markets. That's usually a good kind of benchmark to kind of take a look at as a guide. Another question from John. Sorry if I missed it, but what is the increased percent of new short-term rental properties and maybe specifically new vacation rentals? Destin would be a good competitor showing year-over-year growth of available properties. So yeah, John, we did cover that in the beginning, and we did go and look at kind of market by market what those increases were. But do you want to say anything specifically about the Destin market?
Yeah, I can.
Maybe I can put that back up on here real quick. We can talk to it.
Let's see. The Destin wasn't on the chart, so it's
no, right. But the question about the year-over-year increase in short-term rentals, I think that was the first one we looked at.
Overall for the industry, listings were up about 15% on a year-over-year basis.
Yeah.
If we look at a market specifically like Destin, and as I said, the coastal markets, we're seeing some of the lower supply increases in this last year compared to what we were seeing in previous years, where some of these markets were seeing big growth in 2020 and 2021 and 2022.
Right. So Jamie, I just put your slide back up. Can you go back to that first one we looked at that showed the increase? This one's looking more at the decrease markets.
Yeah, so that's what I was saying, like that Destin wasn't a market on here.
No, that's fine. Yeah, but yeah. I think in general the question was, so we did cover this in the beginning, and clearly you can see a lot of the increases in the 20, 30, 40% range in a lot of these markets on the right-hand side.
Just to put in context for Destin was up 13%.
Okay. A little bit higher than Atlanta.
Mm-hmm.
Gotcha. All right. So as we come to a close here, I wanted to also ask you, I know while we were, we both co-hosted a live event in Atlanta several weeks ago, and you had mentioned that AirDNA might be changing the way that it provides subscription options, or kind of the way that that's presented. Is that something that you can talk about yet, or is that still in the works?
It's still in the works. I could just say coming soon. And in the next sort of 2 months, you're going to be seeing some big changes coming from AirDNA, and I'm super excited about them. I'm here in AirDNA HQ in Denver right now, where we're working on all the final touches. And I can just say it's, if you've been an AirDNA user in the past or you're one currently, I think you're gonna love the changes to the site. We essentially rebuilt it from the ground up, and there's going to be some great tools coming at an attractive price point.
Very cool, very cool. So even more tools than what's already being provided. Interesting.
Absolutely.
That's great. Well, listen, Jamie,
tools around market discovery too. So
market discovery.
Yeah.
Very cool. No, so we look forward to that. Maybe I can get you back on once you've kind of got all that stuff ready to roll out, so we could take a look at it. That would be awesome. That would
be great. Yeah.
Perfect. Well, thank you so much, Jamie, for taking the time today. I really appreciate it. And hope to have you back sometime soon. And we do have some more live events that we're going to be planning, so I'm sure we'll see each other there as well. And for those of you, B&B Investing Group, if you're interested in learning more about how our program helps new investors, feel free to reach out to me directly on Facebook Messenger, and we can schedule a quick call and see if this is a good program for you or not, to help scale and grow in the short-term rental space. So thanks again, Jamie. Really appreciate it.
Yeah, and I'll just give a plug. If you're interested in hearing more from me, you can follow me on Twitter or listen. We've got a blog on our site. And then we also do a podcast, the STR Data Lab, where we talk about all data all the time.
Perfect. And I'll get those links from you, Jamie, and I'll put them in the comments so everybody can refer to them as well.
Awesome.
Really appreciate it. Thanks, Jamie. Take care. Have a good one. Thanks, everybody.
Thanks for jumping on the BNB Investing Podcast this week. Please click on the subscribe and like button below. For more trainings, property tours, and content, you can join my BNB Investing Facebook group by clicking below. If you are ready to grow your short-term rental portfolio and maximize your monthly income, you can click on the link below to schedule a quick strategy call with Rich or someone from his team to see how we can help or point you in the right direction. Stay tuned for our next episode and hope to see you on the BNB Investing Group podcast.